Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge, number 37, Diversification and Portfolio Construction. Wow, it sounds tough, not too bad once we understand what we're talking about here. So, there's the disclaimer, facts and figures, information only, not advice. Portfolio construction. All we're really talking about is our overall wealth. So that's our portfolio. It's made up of all the different things that we own, and even our own home is really part of our portfolio. So it's our home, it's our super, it's the money in our bank, it's any investment that you've got, and so forth. So if we think of our overall portfolio, then it could be quite different than just looking at, say, our superannuation portfolio, and so it goes on. But generally speaking, what you've really got to consider is what have we got overall. And you see, some people might have three investment properties. Good luck to them, but it comes down to the situation that they are really got a lot of their money tied up in the Australian property market, which could be very, very good at certain times, but not quite so good at others. And are they got too much money? Are they overweight, so to speak, in that particular asset class? So let's have a look at a typical super fund, for instance, just to get an idea, so you get an idea how your super's sort of broken up before you can consider it as part of your overall wealth. If this is a snapshot of a typical super fund, and it's actually the PSSAP, just for interest. That's the Australian government super fund, and they print this little picture as part of their information every year and so forth. And this particular portfolio here is for someone who's got their balanced option. So it's the default option. So if you don't choose how to invest your money in your super in this particular fund, they would put you into this portfolio. And a balanced option is pretty typical. This is the one that nearly everyone would be plonked into if you didn't choose. Now, if you started younger, they might put you into a more aggressive one, but generally speaking, this is probably the most popular option for, I reckon, probably 80% of Australians are in this thing called a balanced option. But what sort of really hits you straight away is that it doesn't really look all that balanced. When you look at that dark blue colour on the right-hand side of the pie, that is effectively the share component. So you can see there straight away that you've nearly got over half your money in things like shares. And you say, well, okay, that's balanced, but not really, because when you take it into account that some of these other little sections of the pie there, even things like alternatives, which has got some of that stuff, is really can be indeed quite high risk. And you've also got to think, okay, you've got a chunk there in property, but even the property might be listed property, which listed property does indeed tend to go up and down with markets and so forth, because people sort of think of it like shares. And so you really do have, in theory, somewhere probably between 65 to 75% of your money is in things like shares. And so you get in the situation where if the share market does indeed fall due to whatever issues are causing it to fall, then indeed you would lose money. You will lose money if your portfolio is in a balanced account. Now that's okay in theory if it's only a shorter term thing and then it rebounds and up she goes again, like we've sort of been seeing over the last decade or so. Over the longer term, yep, balanced account has been quite a nice place to be, because it does indeed have some infrastructure. It's got some bonds and so forth in the fixed interest. It's got cash and so forth to water down the overall risk. But just understand that I do hate that terminology, balanced, because to me I would have thought balanced was sort of half risky and half safe. That's to me what the normal word of balance means, is you sort of balance between the two extremes there. But a balanced portfolio is really classified as medium to high risk. It's certainly not just medium. It's more, it leans medium to high risk in a balanced option there. But you can see that these will vary as time goes on. The manager of the super fund would be moving your pies, your different segments at different times. They would be putting more into shares and then less into shares, more into property, less into property, and so it goes on depending on what's going on. And of course, depending on how clever they are and, well, if they can foresee what's going to happen, perhaps, or they're chasing the market, I'm not too sure. But in theory, if they're any good at what they do, we can be protected from some of the downside losses by moving to something less risky. But of course, if you are in a balanced account, and even if the fund manager really believed that the share market was going to crash tomorrow, because you're in a balanced account and you've chosen, even though you may not have done, you were put there, you've got the option to move it. They will not move all of the money out of shares. They would not, even if they believe tomorrow there's going to be an absolute calamity, they're not allowed to get rid of all of your shares, because as part of their the design of the scheme says if you're in a balanced account, there's a limit to the minimum amount you can have in shares. So just beware that they're not going to protect you, even if they really knew there was problems afoot, which generally speaking they wouldn't anyway. But to give you a bit of an idea there, you can see that the income focused one on the left hand side, that's a conservative fund. And to me, that's where you've got yourself a smaller chunk in the share component. But if you add up the shares and the alternatives and the property, you really still only got about 50% in the cash and the fixed interest, what you'd normally call the safer side of the equation, and so the low risk. So to me, I always think that most conservative funds, to me, are more balanced as far as the terminology is concerned. But anyway, that's just gives you a bit of an idea of the risk you're taking on in a conservative fund. And of course, if you've got a growth account, this is like an aggressive account. Wow, you've only really got in this particular example there, under 10% in what you'd call low risk. And everything is out there. You really believe that the world is really going to go well going forward. So just to give you a bit of an idea of what your super might be invested in. But really, if you're any good at doing an Excel spreadsheet, you really should start adding up all of your assets, and just to see what the pie chart looks like. You can put it into an Excel spreadsheet, and if you're any good, there's an ability to create a graph. And you can actually get a pie chart of your whole overall situation. It can be quite fascinating when you see how, when you start adding your money in bank accounts and perhaps in, say, an investment property, how these numbers do indeed vary. But it's a case of looking at everything. So in theory, yes, if you've got oodles of money in term deposits and bonds and so forth outside of super, then perhaps you can indeed take on more risk with your super, depending on the numbers. Here's a little chart here of Australian super, which is probably one of the biggest super funds. I'm pretty sure it is the biggest super fund, for their performance from June from 2023. And yes, you can see the various different types of portfolios there. And of course, they've got their high growth, which is their aggressive account. But when you look at the, what this thing has sort of done over 10 years, it's pretty attractive. I mean, even their balanced account, it's hovering up towards 9%, and their balanced account has actually been going since 1985. So this thing has been very, very consistent over time. But if you can get sort of 9% over a decade compounding, then this is really starting to look. I mean, if you remember our rule of 72, if you're getting 9%, then effectively 8 years your money would double even without adding any money. But you can get the idea here, obviously, that the more conservative, longer term, the returns aren't as good, which is what you would expect. Less exposure, less risk, therefore less returns. Not always the case. There certainly would be times where you would see our cash and so forth outperform the shares when things are going the opposite way. But take a note, that things can certainly vary over 1 year, 3 year, 5 year. When you're looking at funds and super funds and so forth, it's really that 10 year or plus that you really need to get an idea of what's going on, because if say 1 year, things can really perform not as we anticipated in 1 year. The longer term is what we're aiming for. By the way, a stable account at the bottom there, that's sort of like halfway between a conservative account and a cash account. It's only got about 20% in things like shares, and the rest of it's in that safer sort of options and so forth. Just to give you an idea, when we talk about this thing called diversification, we're trying to spread our money over as sort of many things as we possibly can. We don't necessarily need to do too many. I mean, this is a bit of an extreme, this slide here. But what I've done here is to sort of we've got some currencies, we've got some commodities, we've got some bonds, we've got some shares, international, and so it goes on. And you can see there's red and green there, basically showing that even on one day, something can be up. It could be up by 1% or 2% or whatever, at the same time that these other things are just as on the downside. So you can indeed spread your money. But of course, you get to the point where if you're making money on something and losing on another, well, are we actually making any money? This is the issue. It's just a case of making sure that we can indeed make money at the right times, and so it goes on. Now, do we know in the future? No, we don't. But if we've got our exposure to shares over time, they'll be going up, and generally speaking, sort of losses on any sort of bonds or something like that would be smaller while the shares are making up. And of course, if the shares are going very, very well, our portfolio is building up quite strongly. And so generally speaking, a good diversified portfolio over time is going to do well for us. So, but normally what we do is we don't need to get down to this level. This is something that this is what the fund managers and things are doing in the background. They're taking your money and they're spreading it all over the place in different proportions, depending on what they believe is the most appropriate mix at the time. It's be an interesting job, I would imagine, trying to work out, today, this week, next month, next year, we're going to put more money into whatever they believe is the best place to park your money. All very interesting. Anyway, we don't need to worry about it to a degree. We just got to make sure that our portfolio is at least a little bit diversified. I mean, there are some people who don't diversify, where they literally just believe that the share market's the best place to be, so they'll put 100% of their money into shares, and when they believe that the market's going to fall, they then take their money out and either stick it into cash or bonds or whatever. That's either a very brave person or a very smart person or a very stupid person, depending on how they actually do it and what their end result is. But anyway, we'll talk more about this diversification things as time goes on, and how we're going to access all of this easier. Then we don't have to understand, should we have more in oil compared to gold compared to shares? That would be our big call. We're not going to get down to that level. We don't need to. We're going to simplify it as time goes on here. And we're here to help you. Join you on another session.